Well, good morning, everybody. My name is Andrew Paolo. I'm the Director of Member Strategies and Solutions here at the FHLBank Boston. Thank you for joining us today. We're happy to have everybody with us to discuss balance sheet strategies in the current environment. So, to say the least, it's really been a turbulent time for the financial markets, with the added challenges of it being paired with a health crisis and a shock to really what society defines normal as. And it's real, and the conditions that we're all dealing with have been of a scale and breadth of an impact unlike anything we've ever really experienced. So for today's webinar, what we'd like to do is go over three main areas. First, we're going to start out with some key observations about what happened over the last few months in interest rates. Secondly, we'll point out some conditions that members are focused on right now as they navigate and manage their balance sheets. And lastly, we'll talk a little bit about what should be on the radar going forward. So as we go along here, if you have any questions that you'd like to submit, feel free to enter them using the widget along the right-hand side, and we'll address them as they come in or towards the end. So jumping right in, ceiling. So when we see those rates move higher because the market gets flooded with high amounts of supply, that can put pressure on yield. So it's something to keep an eye on as we get to the point where the Fed is going to have to be increasing the amount of issuance that they have to fund all the stimulus programs that they have coming down the pike. Moving on to the shape of the yield curve, again, attempting to find another silver lining is that some slope return to the yield curve. So whatever tenors you're looking at the very short end or looking at further, it's still relatively flat historically, but if we put any merit into this being the new normal that we're in, at least it's not inverted at the tenors that are important to most of the depository members. So the basic banking playbook of lending long and borrowing short can still begin to work independent of any additional credit spreads that may be in play. So when you look at the advance curve, you can see that the shape is considerably different now versus what it was towards the end of February, when it was inverted at a number of tenors, but also relatively flat before you're extending out beyond 5 to 7 years. As the crisis escalated, the pendulum swings, as we've often seen in this post-Great Recession world, are pretty large. And we saw, so this chart shows the 10-year Treasury yield as well as the S&P 500. So what we saw is that as the crisis began to escalate, as is often the case, the bond market is a step ahead of the equity markets in terms of reacting to the conditions and flicking the switch to risk off as opposed to risk on. So Treasury yields moved down, started to lead the way, moving down as compared to stock prices. And one thing I do want to point out here is that in the middle of March, if you can see, this was the depth of the liquidity crisis and the dislocation in the markets, is that Treasury yields actually backed up pretty significantly in that middle of March. And what that is really the most extreme version of the risk off sentiment. So the flight to quality of the risk off is often defined as, risky assets get sold and folks move into more defensive assets like treasuries. Well, this most extreme version is when even treasuries sell off because the liquidity crunch is so severe that it's all about getting access to cash. So even the safe haven of U.S. treasuries in that moment, and they've since resumed moving towards all-time lows, in that moment of dislocation, that they were impacted as well. So now we're looking at the situation where equities and bonds have a different view of what is going on. where equities seem to be focused on the worst case scenario for the economy and markets being avoided. Bonds seem to be more focused on the minimal odds of a positive scenario playing out for the economy and the market. So very tempered amounts of growth and inflation, or in fact the possibility of deflation. So this is looking at equities at large, but one thing I do want to point out is that banks and insurance companies have actually done a little bit weaker than the broader market. So through the end of last week, the S&P 500 was down about 11% for the year, and the constituents who were insurance companies were down about 27%, and banks were down 40%, which was in line with the energy and the automakers, who have been under fire as well. So it really speaks to what investors are looking at in terms of the potential credit issues that may be existent in the banking books, and also the prospect of softer earnings going forward. One last thing to point out about bank stocks is that even if you're a mutual or a credit union, and obviously you don't have those reporting requirements, because of the COVID-19 crisis, a lot of banks have provided a lot more granularity in their earnings reports and their investor presentations in terms of breaking out the industry exposures in their loan portfolios, their PPP issuance. So if you ever want to find out more about what's going on at the community and regional bank level, then those public documents are a wealth of information. So moving on to what members have been doing, and it's really been focused on three main areas in terms of supplementing the amount of on-balance sheet liquidity, assessing the impact of all the stimulus programs, and then tactically and opportunistically deploying assets in areas where there may be some potential value. So on-balance sheet liquidity has been the primary focus. So through the beginning of March, when the conditions really started to get worse and the prospect of the health crisis was really becoming a reality, many institutions look to support the on-balance sheet liquidity, and there were a couple of main areas of focus. When we looked at where the volume and the activity came from, we saw a lot of correlation between those members who had high exposure to commercial and industrial loans, where their customers, their banking customers, were looking to support their liquidity because of the disruptions to their cash flow. So they were drawing on those lines. So that need for immediate liquidity from the banks led them to coming to the Home Loan Bank to provide that instant on-demand liquidity. The other area of focus was commercial real estate. When you look at the impact in certain industries that are reliant on the foot traffic and the activity, so whether it's or travel, so you're talking about the restaurant industry, the hotel industry, hospitality at large, members who knew their loan portfolios backwards and forwards and knew that those are potential credit situations, maybe not in the interim but maybe over the next few months or quarters, that led to a little bit of a ramping up of on-balance sheet liquidity. And one thing to point out is that rather than just plugging the gap with very short-term advances, we did see asset-sensitive members extend out the curve further than you might have thought, given their interest rate positioning to the 6 to 12-month range. And I think that really speaks to the uncertainty of not necessarily of where rates were going to be going, but what the asset side of the balance sheet was going to look like from a credit perspective. We also did see significant flows on the front end of the curve from members who utilized broker deposits. So as volatility ramped up in the markets and liquidity dried up there and pricing was either non-existent or considerably elevated, we did see flows come in to advances because of that. Lastly, bond market volatility. This is most relevant for our insurance company members. That as the dysfunction in the primary and the secondary markets really across the board. We talked about a little bit before about how even treasuries were no real safe haven in terms of a liquidity perspective. So that as you move down the credit ladder into things like asset-backed securities, municipals, it was exponential, really, the impact and the lack of volatility. So we saw folks who were infrequent or smaller borrowers really look to come in and support their liquidity position. And, you know, there was a lot of qualitative analysis and numbers that we were able to look at and see who was coming in and why and to what amounts. But I really think the most important thing was the qualitative aspect of it is that a lot of members who have a lot of experience going through a lot of different interest rate and credit and liquidity cycles, they know that when it comes to risk management, it's better to act now and support liquidity and ask questions and figure things out later. And that's what they were able to do. So as the crisis started to slow down, it went from a situation of having a lot of liquidity to having too much, from needing a lot of liquidity to having too much liquidity. So we talked about the market volatility and as states begin to shut down some parts of the economy. And then we also had the challenge of the normal things that happened around the quarter end filing dates. So as the stimulus programs came into play, where the PPP provided loans for customers, but a lot of the feedback we heard was that very often those loans were getting deposited right into the demand accounts for those members. So deposit levels were relatively elevated as well. And then there's the normal flight to quality deposits that happen when volatility comes and members start to see deposits coming into the bank or credit union that weren't there previously. And then, you know, thankfully, we've started to see some promising signs in the response to the virus. So that has, it seems to avoid sidestepped the unthinkable worst case scenarios that were really front of brain in the beginning of March. So that has led to a little bit of a softening there. So when we think about the wholesale side of the balance sheet, when you're flush with liquidity, then you don't have as much of a need for the wholesale liabilities that you may have previously. So, you know, as we look at ways to recalibrate the balance sheet with existing advances, there are things that you, the member, can do to reposition the balance sheet to address the current changing conditions based off of any advances you have currently outstanding. So the way that we look at some of the alternatives that you have at your disposal, it looks at it two ways, is what your growth or lack of growth anticipates to be for the wholesale funding side of things, and what your sensitivity to absorb any fees through the income statement may be. So very simply, if you're looking to shrink the wholesale side of the liabilities, then you can allow, and you have advances at the short term, then you can allow them to roll off. If you included in there, aside from allowing advances to mature, is also the ability to exercise calls. So we have a number of advanced products where you have the option to call the advance before maturity, and it grants you that control. So to reduce the amount of funding that you need, whether it's driven by less of a need for the total amount, or it's rate and opportunistically driven. So it allows you to be a little bit further out of the curve tactically, but you can collapse it if it's something that is needed at that time. So, you know, one thing that we've seen ramp up over the last month or so is members prepaying advance because, as they told us, they're looking to delever the balance sheet a little bit, and they want to mitigate the impact to the income statement by prepaying the advance and pairing off that with securities gains. So it allows you really to accelerate the shrinking of the balance sheet, as opposed to letting advances run off and letting P&I and amortization occur. It allows you to pull forward maybe a couple months of that natural balance sheet runoff. And if you have the mix of securities and advances where you can pair those off, then you're able to do that. So that's if you're looking to shrink. If you're in more of a stable position, there are additional things that you can do, and we won't go through each one of these individually, but I'm happy to speak with you and put some numbers and ideas behind some of the things that you can do. But very briefly, I'll just mention that if you are in a stable position in terms of balance sheet and wholesale growth, depending on if you prefer to avoid the fee or you have some capacity to do that, there are things that you can do where you can prepay the advance and pair it with the security gain and leave it as is, or relever, and it can be a positive to net interest margin. And in some cases, when talking about the restructure paired with the security gains, it can even be some supportive of current period earnings and even things like regulatory capital. So again, happy to take a look at the advanced portfolio and have a deeper tailored conversation if that is something you're interested in. Lastly, in terms of what members have been doing, is taking advantage of wider asset spreads. And if you're in the camp right now where commercial loan activity has been robust and it's adequate for where you want to be able to grow the balance sheet, then you're one of the fortunate ones right now, because from everything that we've been hearing from members is that the focus really has been on forbearance and managing of existing credit exposures on the commercial side. And when you look at the new opportunities, that they're really few and far between, because they're adapting to this new normal of trying to develop business in this lockdown environment. So the area where we've seen the most opportunities are in terms of residential credit. So both the loan side but also the mortgage-backed security side. So whether you're looking at loans or MBS, towards the end of March, mortgage-backed security spreads widened out pretty significantly, and especially in that period where Treasury rates were backing up, that led to MBS prices being trading very, very weak. And we did see a number of members who came in opportunistically to borrow advances and put on mortgage-backed securities to support the balance sheet. So and residential pipelines have been very robust as well for on the lending side. So if you have some capacity to take interest rate risk, if you have some capacity to take fixed rate loans onto the balance sheet, the spreads are wider despite lower yields, but you have the ability to capture more return and less risk than what was historically available for the better part of 2019. The other aspect of what members are doing right now is to consider the cost of cash. So, last summer we saw a lot of conversations from folks as the yield curve was inverted to say the arithmetic just doesn't work for us to be continuing to reinvest out into the belly of the curve. So when you looked at where the 7-year Treasury rate was versus Fed funds back at the August and September of 2019, it was at a spread of negative 75 basis points. And that also, to compound the issues, if we were to look at mortgage-backed securities, spreads were relatively narrow there. So you were barely eking out a gain, a positive spread by investing in mortgage-backed securities versus what was available as a cash alternative. So unless you were specifically trying to add duration to the balance sheet and were willing to subsidize lower amounts of spread income, it just wasn't really attractive. So now we're in a similar but different situation where rates have come down pretty sharply, and the difference now is that there is some slope to the yield curve, and treasury rates are and mortgage-backed security rates are considerably higher than the cash alternatives. So I'll point out the thing in the top right there where it says, first and foremost, any discussion about strategic deployments and non-cash investments is mute if you're not comfortable with the capital and credit exposure. So the cost of cash is a cost well paid if your capital levels and your credit exposure has to be right sized. But if you're feeling that you're in a comfortable range, and I would implore you to look at things from a spread, not a yield perspective. And I know it can be challenging to see we're in the 0 to 1% world and say, well, how does the math work for us to buy, to add leverage and build up the investment side of the balance sheet? Well, it's about the spread and not the yield. And when you think about using advanced collateral to fund these purchases, it enhances the amount of on-balance sheet liquidity, which is a very important thing right now, by transforming the loan collateral and borrowing and purchasing the securities, which are supportive of the liquidity calculations. So what can members do now and going forward into the future? So, there's three things really that we can talk about. And I think an important way to look at it is to consider the wholesale balance sheet much like using one of the tools that unfortunately all of us have had to use over the last 2 months, and that is the business continuity planning or the contingency planning in terms of transitioning to remote work and dealing with this type of situation. So when you look at the wholesale balance sheet, you can always look at it from the perspective and say, what does our balance sheet look like today? What happens if rates go up 100 or down 100 or credit shocks happen here or there? And any decisions or tweaking is done to the current decision-making process. But one way that you can look at the wholesale balance sheet today is prepare now for the opportunities that may come down the pike a little bit later. So before we jump into those, I just want to point out a couple best practices things here that are going to be consistent across the board. So first and foremost, call your relationship manager. They're fantastic. They work hard for you. They have their finger on the pulse of what's going on across the industry, and they know how to maximize your relationship with the home loan bank. So whether talking about making sure that you have every penny of collateral available to you, they know how to dig through the various categories and make sure you're doing the things that you should be doing. The housing community investment programs, we're currently in the cycle right now with the Jobs for New England program. And on top of that, the regular CDA programs. In this low rate environment, the basis point discounts go a lot further in terms of the discounts versus the classic rate. The letters of credit is a valuable option to add liquidity by unlocking securities that may be pledged for deposits. And the advanced renewal discount program is something in line with the HCI programs that can provide significant value, especially in this 0% low. On the asset opportunity side, this is a little bit of cherry picking in hindsight 2020, but really to emphasize how dislocated things got in the middle of March. So Coca-Cola brought a bond deal on March 20th, really at the height of the dislocation in the corporate bond markets, and at a spread that was significantly wider than where those bonds often trade. And back then, if you had the foresight to purchase that bond and match fund it with a home loan bank advance at the 5-year mark, you'd have 137 basis points of spread. A month later, in April, when conditions had calmed down considerably, Coca-Cola came back to the market and issued bonds at much, much tighter spreads. And at the time, now at this time, the spread was uneconomical. In fact, it was negative if you were to purchase this bond. So, and if we were to look at the municipal bond side, which is an asset class that many folks are involved in as well, then there's the opportunities were even greater. So again, I would implore you to look at all the options for diversification, and maybe the economics don't look right now, but leverage the ability that you have through access to the home loan bank to fund the investments, and because you really have the leg up over those other participants that you're competing against in those wholesale markets, the mutual funds, the asset managers, who they have to sell in those liquidity shocks environments. As balance sheet managers, you have the capacity and the ability to take advantage of those opportunities. So you want to prepare now. So learn what you have to do on the pre-purchase and the ongoing monitoring and the education front, so that when the opportunities are there, you're able to act quickly. And on the last piece here is similar to that. Know all the tools in the toolkit from the advanced solution side. So whatever you're trying to do, know the things that in certain market cycles will have more value than others, and depending on what you're trying to do and are able to do on the asset side, you can do that rather efficiently. So if you're looking to mitigate the interest rate risk and extend out your liabilities, the symmetrical advance is a fantastic tool. It's often priced at just 2 basis points above the classic rate, and allows you to take a gain if and when rates were to rise. The term floaters are particularly interesting in this type of environment, where they give you the exposure to the short end of the yield curve, which is what many folks are inclined to want to do. But because of the longer maturity, it provides you ample liquidity protection. So there's 2 different flavors there in terms of the DNA floater advance and the SOFR advance as well. And the SOFR advance is interesting because it's priced off of the SOFR index, which is the overnight repo transactions. So the driver of that rate is different than the T-bill plus the FHLB cost of funds way that our classic advance are priced. So when our SOFR advance rolled out last October, if you had taken a 6-month and SOFR advance at that time, as compared to rolling a 3-month classic advance or a 1-month classic advance, the SOFR would have ultimately provided a lower cost of funds because it was more responsive to the changes in rates. So it's an interesting opportunity and dynamic there, especially going back to what we said earlier about possible fluctuations in T-bill rates as stimulus-related issuance ramps up. And the member option advance is a useful tool, especially for mortgage assets, as we talked about a little bit earlier. And then I'll end this forward-looking section and presentation with the forward advance. So you may think that the current level and shape of the yield curve is attractive, but you don't have the need for incremental funding because the assets for you to deploy aren't there right now to where you want them to be. So it's an opportunity for you to meet future funding needs based off of today's curve, if that is something that fits in with your profile. So thank you everyone for your time. Hopefully this was useful and informative. And there's my contact information. Hopefully you can find me or the relationship managers or anyone on the money desk. We're here to help. We have tools and analysis that can help you manage your balance sheet, and we're more than happy to do what we can to help you move forward in these challenging times. So thank you everyone, and have a great afternoon.